Florida, Mr. Posey, who has a couple of bills that we've been considering today. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for hearing today's legislation. It's very important to the insurance industry and for allowing me the opportunity to speak today. A question for Mr. Coleman. Dodd-Frank requires insurance companies can be made to serve as a source of strength for affiliated depository institutions. State insurance regulators wall off assets of insurers from other affiliated companies because insurance assets are supposed to be available to ensure an insurer can meet its obligations to policyholders. But if an insurer is expected to serve as a source of strength to non-insurance firms, couldn't that harm the insurer's policyholders? Why would we favor protecting consumers of banks and other risky financial firms over protecting innocent insurance policyholders? I mean, they're the most innocent potential possible victims. It seems like we want to focus, Mr. Schwartz wants to focus on protecting the investors in these institutions that, can't keep themselves in business, rather than worry about the victims when they're forced to go out of business. Just like your thoughts.
I think to answer your question, we shouldn't jeopardize the policyholders of an insurance company that's state regulated in order to use those assets to divert those to support banks in a bailout.
And I realize health insurance is different. I mean, every insurance is unique, but they all have something in common, and that's people buy insurance to reduce risk. They don't buy insurance to increase risk. And if you start stealing from Peter to pay Paul, what you may have, instead of one guy going out of business, you get two. And I don't know how that's better for anybody, but, my experience with federal regulators in the insurance business, I don't know, Mr. Schwartz, if you've ever heard of TRG, but it's a health insurance company that wrote insurance policies in 48 states, darn near every state but their own, which was in Indiana. Everything was fine except they didn't pay any claims. And they bluffed most of the state insurance commissioners into thinking they couldn't go after them because they were under the federal ERISA program.
To be clear, I also support.
And finally, one state said, if the federal government's not going to do anything, maybe we will. And 13 state agencies from different states cooperated to bust those dirt bags and put the principals in prison. To this day, the federal regulators have done absolutely nothing. They have brought no charges. They're just, paralyzed with inactivity. So when I hear somebody kind of insinuating that state regulators are bad and federal regulators are good, my experience has been just the opposite. And while we all believe, I think probably most of the people here have come up through various levels of government, they know that the government closest to the people is usually the best, the most responsive, the most efficient, the most effective, the most cost-effective, and certainly the most accessible. And I think that goes for regulators too. I think that goes for law enforcement too. I think, all services that are regulated more closely. Now, I see nothing wrong with cooperation from the federal government to, unlike what they did in the TRG case, to facilitate enforcement across state lines. But I think the state regulators are fortunately for most consumers, the best line of defense against innocent victims. Mr. Chairman, I want to thank you again for bringing these up. They're very important issues.
And
I'll go back.